Jurrien Timmer, the Fed is widely expected to hike rates this week. So should investors fight the Fed in 2016? Do you want to be in stocks?
Short answer is yes, especially if you're an active investor. There's been a very big discrepancy this year between sort of the global economy, energy, materials, industrials, and sort of what we call growth, healthcare, technology, consumer, discretionary, very, very large gap in performance. So if you're an active investor and you can sort of wade through what's working and what's not, then 2016 should be, I think, basically a repeat of 2015.
And speaking of the Fed rate hike, the dollar could certainly get stronger, especially because they're easing in Europe. So how will this affect multinational earnings? Because earnings growth is slowing.
Earnings growth is slowing, and about half of the earnings are coming from buybacks. So it's not all sort of organic earnings growth. So I think with the dollar, the dollar has been going higher, and it's pretty much a consensus call that it will continue to go higher just because we have this policy divergence, right? So Europe is easing, as you mentioned. The U.S. is now, like the Fed's now going from a sort of a passive tightening of ending QE to an active tightening, presumably in a couple of days. And China is trying to ease also because its currency is overvalued. It needs to come down, and of course it's tied to the U.S. dollar, which has been rising. So that puts some pressure on the Chinese currency. So we have this policy divergence, and that's generally makes the dollar go higher. And obviously that's not a good thing for certain companies that get their earnings from overseas. So I think it's more tied to the global cycle being relatively slow, and the U.S. cycle being relatively strong.
All right, what about the energy patch, the oil patch, if you will? Certainly it's seen a lot of pressure. Also seeing a lot of pressure in the junk bond market. There's fears that this is going to contaminate the rest of the market. So can you talk oil for a little bit?
Yeah, so oil obviously is under significant pressure, $35 a barrel. For me, the canary in the coal mine, if you will, are credit spreads on high-yield energy bonds, and that spread is over 1,400 basis points. So there's a significant amount of distress in the energy sector, and earnings in the energy sector are down 60% year over year. So a lot of stress, and oil needs to go higher to kind of bail these companies out. But when I look at the credit spread, that's sort of the leading indicator. As long as that keeps getting wider and wider, it looks to me like that vice is still being squeezed. But at some point, it's almost a matter of math that oil prices have to recover. But it's just not happening as quickly as a lot of people thought, and that's why we opened up this earnings gap between sort of the overall earnings for the market and earnings ex energy, and that's why overall earnings have been basically flat at this point.
And we are still pre-Christmas. So how strong is the U.S. consumer? Clearly, the employment rate is fairly low. People are still getting hired. Rates are still low. People in a good mood out there, are they going to go shopping?
Yeah, I mean, you just see, if you go out, the roads are busy, the malls are packed. So the U.S. consumer is doing well. There was a lot of pain after the financial crisis because really the problem in the U.S. was too much debt in the household sector. Households had basically monetized their home equity and created basically too much leverage. But a lot of pain has been taken. Household debt to GDP has gone from almost 100% to about 75%. And obviously jobs have come back. The unemployment rate has been cut in half. And so the consumer is doing pretty well.
All right, and what's the one thing that will undo your forecast in the coming year? If there's something that you're really worried about that could really cause you to rethink your entire forecast predictions for next year, what would it be?
Yeah, so when I look at what can go right and what can go wrong, the risk, in my opinion, is that oil prices will not recover quickly enough for the consensus earnings forecast for next year, which is about 7%, to be fulfilled. Because, in my opinion, valuations are fairly neutral here, 17 times earnings, 18 times earnings. So all you really can do is you take earnings, you add dividends, and that's your return. And that's basically what happened in 2015. No earnings, and therefore the market is flat. So in 2016, the forecast is for 7% earnings growth. But the forecast for ex-energy earnings is also 7, which tells me that the market is not pricing in the risk that oil is going to stay low and that there's going to be ongoing sort of erosion in earnings for the energy sector. And so if oil prices don't rebound quickly, I think this is more of a first half problem than a full year 2016 problem. But then the risk is that you're not going to get the earnings in the market, and therefore you're not going to get a lot of return. It's not necessarily a bearish call, but it's a call. There's some downside risks to the consensus estimates for earnings.
We're going to watch oil very closely. Thanks a lot, Jurrien.
Thank you very much, Greg.
Thank you for watching The Street.